The rise in inflation is driven by a multitude of factors. These include strong demand as economies are recovering from the pandemic, oftentimes aided by substantial policy stimulus, pandemic-related supply bottlenecks, and a shift of spending towards goods as in-person services were more disrupted by pandemic restrictions. And of course, the invasion of Ukraine is a further compounding factor that is putting pressure on inflation. Household expectations tend to get less attention than the other more readily available measure of inflation expectations. Recent studies, for instance, show that household inflation expectations matter for consumption and savings decisions, for financing and home ownership decisions. From a theoretical perspective, they should also affect wage negotiations and labor supply decisions. It has further been shown that household expectations are relatively closely aligned with the expectation of small and medium enterprises. So new research that we have been doing here at the IMF, we look at the predictive power for future US inflation of various moments of the distribution of the Michigan survey data. We find that changes in US household expectations at the one-year horizon contain important information about future inflation and potential de-anchoring. In particular, there's information contained in the shapes of the distribution. It is not enough to simply look at the average expectation. One needs to examine the microdata.
It is also confirmed by the numbers that came out yesterday, the spring forecast by the Commission, showing that demand is still rather weak to some extent. And you see from this graph that the gray area shows, which are the Commission forecast for output gap, shows that this year the output gap will still be negative and will only marginally go into positive territory next year. What that means? It means that central banks need to be cautious. Now, it's like a Pavlovian reaction, bringing interest rates back to positive and towards a neutral area, but needs to be very cautious because the reaction could be a sharp drop in aggregate demand. Now, would the central bank still need to react? I would say yes. Yes, because as it was mentioned, there is a risk on the expectation side, not only household expectations, but also market expectations, and of course, behavior of wages. Now, these things can happen overnight, can happen very suddenly, and central banks would not have the time to react because monetary policy works with long legs. Therefore, it is probably reasonable to adjust policy rates now, but again, it needs to be done very cautiously. Now, you see from this graph that wages have not yet shown any significant signs of picking up, although I have to say that some anecdotal evidence recently seems to point to a sharp increase in some countries and some sectors. Having said that, a recent graph presented by Philip Lane of the ECB showed that even forward-looking measures of wage inflation showed an increase of 3%, which, taking into account the productivity gains, would still be consistent with the 2% ECB target.
In our forecast, which we do on a quarterly basis, it's unsurprising that energy, as you see here on the left side, is the major driver of headline inflation, and that continues to be the case for the remainder of this year, and also remains to be above the steady state, above the historical average going into next year. Headline inflation should be peaking this year, and the peak will be shifting depending on how you see the de-escalation of energy prices. As a matter of fact, in our baseline, we assume that energy prices will come down quarter by quarter to the tune of about 5 to 10%, which means that we should see headline inflation peaking in the Eurozone mid-year at the end of summer at the very latest. But if oil and gas prices continue to be rising, then that peak will shift towards the end of the year. When we focus only on one-year inflation expectations across the board for all measures of inflation expectations shown here for the US on the left and Eurozone on the right, whether it's business surveys, household inflation expectations, professional forecasters, or market based inflation expectations, they've come with a lag. We've seen a remarkable development over the last 6 to 12 months, where inflation expectations based on models. So both in the US as well as in Europe, you see the red line reflecting the market-based inflation expectations. Those have been remarkably high and way above what our models would suggest. And those models, as you've seen, have historically fit inflation expectations quite well. So something's going on clearly.
We'll be now turning to the Q&A, and I would like to start with Mr. Adrian again and continue with what he's already mentioned in his closing remarks of the presentation. How comfortable can central banks be that inflation expectations in advanced economies are well anchored and will remain so? And if I may add additional question to that, what is it that the central bank should do or not do to ensure that the medium-term inflation returns to target?
Let me break it out into two parts. So number one, what is happening with inflation expectations? And number two, what should central banks do? So in terms of what's happening with inflation expectations, there are some signs that inflation expectations are moving up, especially in the shorter term. In the medium term, to date, there remains some anchoring. But what I'm trying to argue is that there is a lot of risk of that shifting, right? So I would distinguish what is the central path, the modal outcome, and what is the risk around the modal outcome. And I think even if you believe that the modal outcome is one where inflation will likely come down at some point, there's a huge amount of risk to the upside of inflation continuing to rise. So that brings me to the second part of the question, which is what should central bankers do? And so I would argue that you have to take a risk management approach at this point, right? Because, even if the modal outcome, is perhaps one where you think that inflation will come down eventually, where inflation expectations will likely remain well anchored, there's a huge amount of risk that this is not going to happen, that inflation will remain high, that inflation expectations might de-anchor. And I think that the weight of the probability outside of the modal outcome, which is very skewed, should weigh in the policy objective.